Hey, it's Richard Matthews of Matthews Wealth Management. Today we're going to talk about IRAs, or individual retirement accounts. It gets a little bit confusing out there. You've got the traditional, you've got rollovers, SEP IRAs, Roth IRAs, tons of IRAs, and all these acronyms get a little bit confusing. So what we're going to cover today is a little bit of the differences just between the traditional IRA and the Roth IRA. So we've got a couple of categories. We'll just roll right through it. So first thing we want to talk about is the tax deductibility of the contribution. So being able to contribute to an IRA is sometimes part of what a CPA or tax preparer will encourage a client to take advantage of. And what that does is allow you to lower your taxable amount of income and pay fewer taxes this year and get some of that money working for you in investments and so forth to grow down the line. So that's the example of a tax deductible contribution, which is what we have under the traditional IRA. When you hear about a Roth IRA contribution, however, that does not take place. So a Roth IRA contribution is what happens when you take money that's already been taxed out of a paycheck and you invest it into something else that's very different from the traditional IRA sense. So next thing, let's talk about the contribution limits in terms of the dollar. So it's a little bit complex. There's actually two steps involved here, but it's absolutely identical for both the traditional IRA as well as the Roth IRA. So what we have is the very first $6,000 can be contributed into a traditional IRA. This is assuming you don't have a 401k at work. A lot of this stuff can change, but we're going to go with some constants here. Now, if you're actually over the age of 50, you can make what's called a catch-up contribution, assuming you haven't been making your regular contributions, but you can save more later on in your career. So we're going to add another 1K to that. So we've got a total of $7,000. It's absolutely the same when we're looking at the Roth. $6,000 with a catch-up contribution of 1K. So when you're talking about these contributions, if you make money like the top 1% out there, then you might get caught out. Obviously, when you're doing things either tax deferred or with some tax incentives, the IRS really wants that to be for middle class and lower income individuals and families to help them get a leg up on saving and putting back for retirement. So when we're talking about a contribution income limit, again, these are both identical. And what that comes down to is you look at your modified adjusted gross income, MAGI, and you can find that on your tax return. But that number comes to, for the year 2020, married filing jointly. Again, you got to remember these things are different for different situations, but we are at $196,000 for married filing jointly of a modified adjusted gross income. Now, at this amount of income or lower, you can contribute the $6,000 per year, and that full $6,000 will be tax deductible. As you go up higher from the 196, they start to phase that out. So it's the same thing for the Roth IRA. If you make less than 196,000 married filing jointly, you can contribute to the Roth IRA the same amount. So in that sense, both IRAs are identical in the same situation. All right. Next area we're going to look at, once the money is invested into an IRA, what is it actually invested into? And so I hear a lot of clients or prospects or friends say that I have an IRA at the bank, okay? And what that implies is that the IRA itself is an investment. Technically, the IRA is just the account. It's an individual retirement account. That's what it stands for. So what it's invested in at the bank, typically in that situation, is CDs. So CDs paying a stated rate of interest. They roll each year or 5 years, depending on the term. But you also can have traditional IRAs and Roth IRAs at brokerage houses and different other institutions for investments into things like stocks, bonds, real estate, commodities, etc. So both of these invest in all sorts of different types of assets. Okay? So that's once the money's invested and inside of these IRAs. Now let's move and shift towards taking money out of IRAs, and we start to see some major differences here. So first thing we're going to talk about, if you can take your withdrawals out without paying taxes, especially we're talking retirement here, and that's the R in IRA, that is a huge advantage when you're drawing Social Security or a pension or dividends off of your other savings, to not have to pay additional tax on the IRA amount that's been growing over time. So this is when we're talking about long-term tax planning as to why we would do one versus the other. But when we're talking about tax-free withdrawals, we're talking about the Roth IRA. Tax-free withdrawals, that is not the case on the traditional IRA. So you can already see the main difference between a traditional and a Roth. The traditional is tax deductible on the contribution, but you have to pay taxes on the back end of it at full income tax rates, which is brackets and so forth. So on the flip side, the Roth, you don't get that initial lowering of your tax, but the benefit is you don't have to pay the tax on all those future gains either. Okay, so there's pluses and minuses to each of these. Doesn't mean one's better than the other. There's a use for each one of them, but these are just the differences of money going in, money coming out. So let's talk about the 10% early withdrawal penalty. That exists on both the traditional as well as the Roth, with a few caveats, some things that change slightly. So we've got a 10% early withdrawal penalty in most situations, unless we're using it for qualified expenses like education, first-time home buyer, etc. But there's also some additional stuff we'll cover in some future videos for how to take money out of IRAs and avoid this 10%. But that exists on both of the accounts. And very lastly, the thing we're going to cover is what happens when you pass away. You know, when we're talking about beneficiaries, that's your heirs. That's people that you're leaving these IRAs to once you pass away. So lifetime Rmds, it's kind of, if you're not familiar with Rmds, it stands for Required Minimum Distributions. And what that's about is that the IRS requires most people to take a certain percentage out of their IRAs at different times in their life. And what that does is typically it'll make things more taxable on the distributions. But for the beneficiary, there's a new Secure Act that came out at the beginning of 2020, and that's really limited the difference. It's created a difference and limited the benefit of being able to take a lifetime minimum distribution, because that percentage was much lower at lifetime level than it is when it's shrunk to spend it all in 10 years. So the traditional IRA does not have that luxury anymore, whereas the Roth does. So that was a major change this year, and it really should force a lot of people to go back and look at their estate planning and say, are we leaving the right types of accounts to the right beneficiaries and factoring in their taxable earnings? Because if they have to take out all of an IRA that's traditional in just 10 years, that's really going to bump up the beneficiaries' tax brackets. So that's an active part of tax planning that we're going back and talking to clients about to try to take advantage of how we can get more of it now into the Roth IRA to minimize the beneficiaries' taxes over time as well. So hopefully this has been helpful in trying to understand the difference between a traditional IRA and Roth IRA, and this should be a straightforward representation. If you have any questions and want to get in touch with us, feel free, we're here to help.